Hi, this is Les Goss, Senior Note Pro with the Riverstone Fund. I'm here to talk to you briefly about a type of real estate investing you may not be particularly familiar with right now. Most of the people that I deal with have been investors in multifamily projects. They've owned their own homes that they've rented out. They may be investors who are fix and flippers. And all of these people are finding it more and more difficult today to find a real estate investment property that makes sense because the economy is so strong now, or coming back pretty well, and the real estate market in our area for sure is very strong. It's just getting harder and harder to find properties of all types. In fact, recently I was looking at a 30-unit apartment I've had my eye on for quite some time. It'd be a great addition to our portfolio. But within a day of it going on the market, somebody had come in, offered more than asking price, and offered to pay all cash. Well, that's pretty tough to compete against. However, more and more investors are finding out the advantages of investing in real estate backed notes, where you're actually the bank and not the property owner. I'd like to go through a few of the advantages and give you an example of what I'm talking about, starting right now. So, why would someone invest in real estate backed notes anyway? Well, first of all, you're the bank, not the landlord. This has a lot of advantages. You may have been part of a ownership of an apartment, or you may have owned a rental property, and you know that if anything goes wrong, you're responsible. You've got to get the roof in shape, you got to fix the furnace, you got to mow the lawn, you got to fix that broken window and the stopped up toilet. All those things are part of the package when you own the property. However, if you just own the note, then the people who are the owners are just sending you monthly checks. If you think about your own home, if something goes wrong, you sure don't call Wells Fargo and tell them, to get over there and get it fixed. You just send them their check and you call somebody else. So that's one of the big advantages of getting into real estate notes. Absolutely no hassles with the property itself. Plus, there are more good deals available as notes compared to a bricks and mortar purchase. As I referred to earlier, it's getting more and more difficult to find bank-owned properties or properties that investors or single people want to sell. And the money that's coming into some places like Denver now is just incredible, and it's all big cash and tough to compete with. So if that's one of your strategies, maybe time to look for something else. Notes give a much better return than your CDs, your IRAs, or bank accounts. If you've got money sitting on the sideline waiting for a good investment to come along, you may be like many investors who are not too fond of the stock market. Seems to be going well right now, but you've been burned before, probably lost half your money when the 401ks went to the 200s, and not looking to do that again. But making 0.01% or maybe a whopping 0.5% in your CD just isn't even keeping up with inflation. Plus, the investment in a note is backed by real estate. So, and that we've bought at a significant discount. So if something goes wrong and you have to get the property back and sell it, you've got a large cushion there where you can still make a good profit, even though it didn't go exactly as planned. So how does this work anyway? Well, the first thing you have to do is find a willing seller, someone who has a real estate note that they'd be willing to sell at a discount. This might be a bank, it might be a hedge fund, or it might be an individual. Right now, the hedge funds are buying these notes from banks by the hundreds of millions of dollars at a time size, which we're not competing with. There are also individuals out there who have perhaps sold one of their properties on an owner finance deal, so they've got a monthly income coming from their owner. So why would a note seller sell at a discount to its face value? If somebody's got a note that says the borrower owes $100,000, why would they sell for $75,000 and let all that money go off the side? Well, part of the reason is their monthly payments that they're receiving don't really make a big impact on their lifestyle. It goes into the bank and it probably gets spent. So if they're making $500 a month, at the end of the year, you'd think their bank account would be $6,000 larger, but they find out that it's really hasn't grown at all, and they still owe taxes on that money. So at some point, if they've got a big plan that they like to maybe buy an RV and go retire on the road. Maybe they want to take that dream vacation. Maybe they've got other bills they want to pay off. Maybe they want to pay for their grandchild's college education. Whatever it is, they realize that getting a big chunk of cash now is better for them than letting it dribble in from now until 30 years from now. So that's why they're willing to let those go at a discount. As far as the reason hedge funds might want to sell off at a discount is because they set these funds up to run for 5 or 7 years, and they collect investors' money. They buy up a whole bunch of notes and pay their investors quarterly. But by the time the 5 or 7 years is up, they have to give their investors their money back. And to do that, they have to sell off their notes. Again, they're professionals. They know the routine, so they're willing to sell at a discount. They've made their money and more. So how does the Riverstone Fund help you achieve your investing goals? Well, we have access to these pools of notes for sale. You may not have access to many people, individuals with real estate backed notes or hedge funds or banks, but we do have access to this and we can buy those. So we negotiate a good discount on a note. We put a loan servicing company in place to handle your payments and deal with the owner. This means that the person who's buying the house and is making these monthly payments sends them to their loan servicer, and that company sends you your portion, the principal and interest. They also escrow money for taxes and insurance, and then they pay off the taxes and insurance yearly as those come up. So you're always covered, and it's all handled in the background for you. The checks just go direct deposit into your bank account or your IRA. We set up the closing and assure you get all your documents. You don't have to be there. It's all done remotely, and everything's taken care of. It's a real turnkey investment for the investor. So let's take a look at an actual example. This is a 3-bedroom, 1-bath home in Cedartown, Georgia. Now, this is probably not a home you would currently want to buy for your own living, but the couple that's been in here has been in there for almost 8 years, making regular payments, so apparently it works for them. Here is the broker's price opinion, or BPO. This is the document that gives the value, which they came up with $54,000. We also look at places like Zillow, but generally we like the BPOs better, the broker price opinions, because they are compiled by someone actually on the ground. They will go out and take pictures of the house. They will go to 3 other houses nearby, similar size and age, find out what they sold for. They also find 3 current listings in the neighborhood and find out what those are worth and come up with a good value. This is one that we trust more than other sources generally. So we always get one of these. It's also good to find out what kind of neighborhood you're buying into, since I've never heard of Cedartown, Georgia. I have no idea where it is, but it looks from here that it's a pretty darn safe neighborhood that this house is located in. No crimes of any type reported in the last several months. This is an aerial view taken by Google, and you can see College Street over there. You can see many houses in the neighborhood, obviously well-forested town. You can't hardly see any of the houses in there except some of the bigger ones, but they're in there, and the one with the red circle is our property in this case. This is a rental comparison that we got from a web company called rentometer.com. We use this often to find out what the rents are, because it's good to find out in this case that if the person moved out and they're currently paying about $400 in principal and interest, and another 75 to 100 for taxes and insurance. So they're under $500 a month. If they wanted to move but stay in town, for a similar size property, they're looking at 600, maybe six and a quarter. So it wouldn't make sense for them to voluntarily give up their home that they're owning to go find a rental. Now, this is the document that shows everything you need to know about your possible note. This one actually has been sold. This one is not available. This isn't one that you could actually get for yourself. But at the top, it says the current value is $54,000. We saw where we got that number from. The original balance, the principal owed on the loan was $44,495. The owners are paying a 9.99% interest rate. Now you might ask, why would anybody pay that? You can get a mortgage for under 4% today. Well, these people couldn't. They've been in there for 8 years, maybe 8 years ago. They'd been struggling. They had a good income, but maybe they had bad credit score. There could be a lot of reasons why they couldn't quite qualify for a bank loan. That was also a very difficult time to get bank loans. When after the free money was stopped, banks got much stricter on who they would let borrow. But this borrower was able to find this seller of this property, and what works out for them is the monthly payment, under $400 a month, plus tax and insurance. But still, that's, as we said, way lower than rent, and they don't really care about the interest rate. So they bought a term of 327 months to pay, so just under 30 years. They've made about 7.8 years, 94 months worth of payments, so there's 233 payments left on this note. And the unpaid balance is $40,756. The loan to value ratio is 75%, so this indicates that the buyer has paid down enough that they've got about 25% equity in the property. This is a nice thing to see because you realize that they don't want to lose that equity, so they're going to do everything they can to pay their mortgage first. And if they have problems with their income for some reason at some point, they will be willing to put those aside and pay their mortgage first. That's the most important thing to them right now. Below the blue line is the quote that we're showing as an example. In this one, we're showing that if you put down $25,000 and you buy just the next 90 payments instead of buying all 233, which would have cost a lot more, your yield is just over 10% per year for the 7.5 years that this will pay out for you. The investment to value shows that your $25,000 is only 46% of what the house is actually valued at. So if something went wrong and the person had to sell, you've got a lot of cushion in there where you could still make a nice profit, even if it didn't pay out monthly for the next 90 months. So you're probably wondering, well, nothing's risk-free. What could possibly go wrong? Well, the first thing is the owner could sell the property or refinance the property. Maybe they've gotten to a place where that 4% money makes sense, or it will in 4 or 5 years from now. They could sell or refinance the property, and then you wouldn't get the last of your payments. However, you would get a large chunk of money come to you after the closing, and that would be a nice thing to get. Instead of your 400, you get many thousands, and that would increase your rate of return by quite a bit. So that's a good thing, actually. Now, what if something happens to the owner? Somebody dies, they get injured and can't work, they get fired from their job, they can't pay anymore. Well, that is more serious, and there are things we can do, and the Riverstone Fund will help you through this if something should go wrong like that with your note. If you have to foreclose, you get the property back. The first thing we might do is go in and see if they can afford, if we stretched out the payments over a longer period of time and reduce the monthly payment, maybe they could continue paying. Maybe they're just realizing they're done, but they don't want a foreclosure on their record. They've already got bad credit probably. So we can do what's called a deed in lieu, or more commonly known as cash for keys. So we could go in and say, just give us the house back. We'll give you a couple $1,000s to move and get a new damage deposit at your new place. We know we'll give you a couple bucks, couple months rent to get you back on your feet. And so about 40% of the people who get stuck like this are able to um, offer the keys back. Only about 20% ever make you go through the foreclosure process. But eventually you do get the property back. And since you've got $25,000 into it, it's worth 54,000 as of today. You could probably sell that really quickly for say 45,000. You'd have 20,000 above your uh, investment in addition to what you've already paid. So that could work out well for you, even though it's kind of a hassle. Another thing we might do is just after the foreclosure, put another buyer in there and get payments coming in again. So those are a couple of options if something could go wrong. So now that you've got a little bit more information about what real estate backed notes are and how we can help you get those into your portfolio, what's the next thing you should do? Well, I'd like you to download the PDF below this video. It goes through much of what I discussed, and it has all the same documents of the sample that we just looked at. So that would be good for you to look at. I know even after that you'll have some more questions. You wonder how does it work if I'm exactly ready to go now? What's the next step? So please call me by phone or email. It's there on your screen, and it's also on the PDF that you'll download. So for now, that's Les Goss signing off for the Riverstone Fund, and I hope that answered some of your questions, and I'd love to hear more of them from you. Give me a call. Thanks. Bye.